Hello, everyone. Welcome to the TradeStation Masterclass. Today, we're going to do a technical analysis series where we highlight consolidation squeeze and try to explain some of the concepts around this idea. Before we jump into today's topic, just the usual introductions and announcements. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. Always a pleasure to talk about TradeStation and some of the tools available on the platform. Just keep in mind that every symbol and idea that we talk about is for educational purposes only. Past historical performance is no guarantee of future results, and active trading may not be suitable for everyone. So just keep those things in mind. What we're going to talk about today, which is the consolidation squeeze, is an idea, but of course, we have to understand that these are all hypothetical ideas and do not reflect actual investment results. So let's go ahead and keep that in mind. For additional information, go to www.tradestation.com/important-information. All right. What is consolidation? Before I start on the content of this PowerPoint, let me share with everyone a PDF version of this. There it is. So consolidation is defined as a period of low volatility where prices trade within a narrow channel over some number of bars. And this is something that happens on every stock that is trading. And as traders, if we look at a chart, it's very simple to identify because the bars or the candlesticks kind of flatten out and they're moving in a horizontal manner. There's no clear, uptrend or downtrend. The stock has entered what is called a consolidation period. When I say that it's a very visual thing, it just stands out, and it's something that as you get more used to looking at charts, then it'll be easier to identify these periods of low volatility. Of course, we're going to use some technical ideas or some technical studies to help us in identifying some of these areas. Market generally moves between periods of high volatility expansion and low volatility contraction. Two modes, either the stock is moving up, it's moving down. Those are the volatility expansion. It's expanding to a certain new level, or the volatility contraction, which is pretty much, the stock becomes quiet, not much activity, kind of moving sideways. After a strong price movement, it's common to see market indecisiveness, where traders slow down trading and start looking for clues to the next breakout move. And that's the key point in this conversation, that we're going to try to identify those periods where where we identify this indecisiveness and be ready to take action when a breakout occurs. Because when prices do consolidate and when stocks, they enter this period of low volatility, it is something that is expected. Stocks do not remain in a sideways movement forever. Sooner or later, they're going to break out. And that's the reason why we want to take a look at these studies and be ready in case you want to take a trade in that direction. So usually traders look for directional breakouts from consolidation. How to identify a squeeze? Different ways. There are multiple techniques and mathematical formulas to measure this concept. Bollinger Bands is one of the most popular ones. I've used Bollinger Bands in many of my examples because I think it's easy to understand and it's easy to calculate. So those are some of the things that I use a lot in my examples. And the squeeze refers to the bands narrowing or getting closer to each other. So it does happen during low volatility. We already talked about what happens to the price during low volatility. There's a manner in which the prices move, which is kind of a horizontal way, consolidating way. So the bands narrow or they get closer to each other. The contraction is followed by a surge in volatility and price generally breaks through one of the bands When sideways movement is over, a new directional trend may begin. So yes, we're looking for that bandwidth effect, where the bands, get closer, and if you let your fingers go, they kind of retract to their original place. And the same happens, if the bands expand. So we're not only going to look at the bandwidth or the bands to squeeze, we're also going to be looking at the bands bulging or creating these big, extensions, because those are also opportunities in which a trader can say, hey, it's reached an extreme. Now I'm going to capitalize on the prices going in the opposite direction. We're going to take a look at those two scenarios. Measuring squeeze. Okay, the Bollinger Band usually calculates a 2 standard deviation from a 20-bar moving average. The bandwidth takes the difference between the upper and the lower band and divides this by the middle band. We're going to take a look at both indicators and how we can use them and how to use them together, because I think it makes a lot of sense to use them together. The result of the calculation that's on bullet 1, which is, the difference between the bands and then dividing it by the midline, provides you a percentage. The bandwidth value decreases as the Bollinger Bands gets closer and increases as they pull apart. An interesting concept, and it's all with the intention of measuring the squeeze. I want to take a look at some of the values and how to interpret them. The bandwidth value, though, is relative to the symbol and should only be compared to its past bandwidth fluctuations. So what is considered narrow for one symbol may not be for another. And this is something that we have to keep in mind. Price movement is different as you move across different symbols. They all have different volatility, and the concept of a narrow band or a narrow Bollinger Bands is going to be different across multiple symbols because of that price fluctuation differences. So we cannot compare, apples to oranges. We have to make sure that we compare apples to apples. So if you're looking at the bandwidth fluctuations of Apple, now the stock, not the fruit, the stock, if you're looking at the Bollinger Band fluctuations of Apple, it makes reference to study them in context of Apple, not compared to Microsoft or any other stock, okay? Yes, I did post the PDF. Let me go ahead and post it again. That's the PDF that contains this information. You're welcome to click it and download the PDF. It has the same content that I'm sharing with everyone here. On the Bollinger Band squeeze, the strategy signals are the following. The Bollinger Band or bandwidth drops to historic levels. We're going to take a look at how to interpret that. And price breaks through the Bollinger upper band, signaling a new upward trend, and volatility also increases. So yes, that effect of the Bollinger Bands squeezing, getting closer to each other, and all of a sudden exploding. Now, the explosion can either happen to the upside, which would be a bullish squeeze, or they can also break out to the bottom side, which constitutes a bearish squeeze. But they're both of these setups, what they're looking for is for that narrow width between the two bands. So let's go ahead and talk about how to identify those. The Bollinger Bandwidth indicator can help you identify a squeeze in the Bollinger Bands. The squeeze signals consolidation, and a significant move may follow. In a squeeze, the direction of the breakout move depends on which band in the Bollinger Band indicator is broken. We talked about that. If you experience a squeeze, the price activity is due for a breakout, and the breakout can happen on either side of that Bollinger Band. If it happens on the upper band, it's likely for the price to continue to go up in that direction. So that's a bullish signal. But if it breaks on the bottom side, the price is expected to go in that same direction down, and that would be a bearish signal. And of course, it's recommended that you look at other technical studies for confirmation that there's going to be a trend in a certain direction. Pullbacks after a squeeze breakout are common, and this pullback should serve as a warning since the expected rally may never happen. Okay, so some things to consider. These are just ideas. There's no one solution for everything or one behavior for everything. Once you look at, a strategy signal, then you have to make a determination of whether you're going to continue in the direction of that signal, or you're going to analyze the signal itself to see if there's other components with it. If you have a bullish signal and all of a sudden you get what's called a pullback, maybe the signal is not as strong as it was, as you thought it was, and maybe the price is going to reverse and go in the opposite direction. So those are things that you have to consider by looking at the chart and looking at other indicators to confirm. Let's go ahead and take a look at the indicators on TradeStation and how to calculate them. So let me go back here to my platform. I'm going to open up a chart analysis window. All right, this is Twitter. Let me go and pull up a daily chart. 5 years worth of data. Okay, and I'm going to add the Bollinger Band. So studies, add studies. Okay, and we're gonna go and select the Bollinger Band. Bollinger Bands. Okay, I don't think the style is the way that I wanted. I want to do the upper band and the lower band a little bit thicker, and the %B. Let's make that the default so that every time that I load it, it has the same settings. So this is the default Bollinger Band indicator. You can see that the line in the middle, the line that it's plotted in color gray, that is just a 20-bar moving average. Simple moving average, simple calculation. It calculates the closing price of 20 bars. And then the blue band and the red band are what we call the Bollinger Bands. And they're looking at the data price points and calculating standard deviations away from that moving average. 2 standard deviations to be exact. So 2 standard deviations represents 95% of all the data points. So in reality, and when we look at the Bollinger Band, we're saying, okay, if the price activity penetrates the bands, like over here, it penetrated the upper band, it represents a price extreme. It's reached an extreme. It doesn't happen all the time. If 95% of the data points are going to be within the Bollinger Band channel, or the upper band and the lower band, anything that happens outside the bands are extremes. So if we've reached an extreme here on the upside, the Bollinger Band idea is that it'll come back to where the average is. So it has that bandwidth effect where it reaches an extreme and then it bounces back to the mean to where the average is. So that upper band breakout under Bollinger Band criteria is a bullish signal, but when it returns inside the channel, it turns into a bearish signal. So it's kind of contradicting. And we talked about this at the very beginning of the presentation. If you have the Bollinger Bands squeezing, getting closer to each other, we said at the beginning that we're looking for a breakout. And if the breakout happens on the upper side, that's a bullish signal. If the breakout happens on the bottom band, that's a bearish signal. But here, when we look at the prices, we say, well, if it's on one side of the band, like in this case is, it's above the upper band, yeah, that will be considered bullish, maybe as long as it remains above the upper band. But once it returns, and that's the specific criteria or alert criteria for the Bollinger Band. The Bollinger Band does not alert you when the bands are broken. It alerts you when the price returns from those extremes. So that return to inside the channel, inside the Bollinger Band channel, it's a bearish signal. So those are the two different examples that we talked about. As you break the upper band, that could be bullish, but when you return inside the channel, that could be bearish. Okay, so cool. How do we then measure squeeze? Because looking at this Bollinger Band right here on the chart, you can look at when the bars or the bands on the Bollinger Band get closer to each other. And we can identify those areas. We can see that it got closer here. It got closer here. It kind of got close here and over here. But how much and how do we measure that to be precise? There's a calculation happening here, or an additional calculation that we can add here that gives you an exact measurement of that channel and how much this squeeze is. And that's called the Bollinger Bandwidth. It's built into the TradeStation platform. So let's go ahead and add it. I'm going to go add study, Bollinger Bandwidth. I'm going to click OK. I'm going to make these lines a little bit thicker. So the bulge line is dotted, which is okay. And the squeeze line is also dotted. The bandwidth, I'm just going to make it thicker and make that the default. We don't have a thickness for the bulge line or the squeeze line. There's an exercise in one of the easy language answer that allows you to change the thickness on a dotted line, but it's not available on the software, which is really cool. I don't know why that came to mind because I did want to change the thickness of that line and you can't right here in this dialog, but you can do it programmatically using easy language. All right, so I'm going to leave it the way it is. I'm going to click OK. And this indicator plots at the bottom of the screen. So hopefully you can see the lines. Both indicators, the Bollinger Band and the Bollinger Bandwidth, are pretty much based on the same idea. The idea of calculating two standard deviations. But the Bollinger Bandwidth takes the calculation a step further. So let's go ahead and see where the calculation comes from. And for this example, I'm going to stop the chart from updating in real time. The reason for that is because I want these numbers to be static, and the ones here at the bottom, I want those to be static as well. And I can make that happen by just double clicking on the symbol. And let me set the last date. I'm going to set it to yesterday. That way I can stop the chart from updating in real time. So what I see here is not today's data, is what I see. It's the daily bar from yesterday and everything else. Let me open up the chart a little bit and try to understand what's happening here on the bandwidth. Okay, so we have the Bollinger Band values, and the way that you calculate the bandwidth here is taking the Bollinger Bands, seeing what the difference is between the bands or how far away those prices are, and how that relates to the midpoint. So let me go ahead and bring up the data tips window. So data window, there we go. And I'm going to click on this bar. All right. This gives me the information for that specific bar. By the way, there's a feature on TradeStation that is on by default, which is the crosshairs. That is something that was turned on by default in one of the recent updates of TradeStation. I kind of just disabled that feature because if one is turned on, if you bring up the data window and you move the chart around, it actually changes your anchor point and it's not static. So it'll just follow your cursor wherever you are. That feature is right here in settings. If you go to a chart settings and you go to preferences, and it's this one that says display crosshair lines with down click only. This is unchecked by default. So if I click OK, you'll see exactly what I mean by, moving the mouse around over the candlesticks and having this data change automatically. So this does not help me if I want to focus on the data of this, most recent bar, because as soon as I move away from it, this changes. And I want this data window to reflect the data of this first bar. So I have to go here to settings. Let me move the data window away. So settings, preferences, and make sure that you have this checkbox, display crosshair lines with down click only. And that way is back to the way that TradeStation comes originally or before the update where it wasn't turned on. So I really don't like when TradeStation makes decisions of turning things on that may, affect your use of TradeStation? Because I know a lot of you may rely on this data window to make, to make analysis. And if we change a certain behavior by default, it just messes you up for some reason. So I'd rather give you the option to turn it on or off, or at least give you a sort of a warning, So here I can click on the bar here and I can see that this is the data for October 24th, which is yesterday. So I'm going to bring up a calculator as well because we're going to do some calculations. Let me make this calculator smaller. It's a little too big. Okay. And what I want is my upper band, which is 50. Oh, where's my calculator? Okay. My upper band, which is 55.82, minus my lower band, which is 41.75, gives me 14.07. What does that mean? It just means that the difference between the upper band and the lower band, the upper band and the lower band, yes, that said it correctly, it's $14.07. That's the difference between the two prices. Now, if I divide that by the midline is 48.78, that gives me a 0.28843. Where is that value? That value is down here. So that's the yellow line down there. 0.2884 is exactly the value that we see here in the calculator. So we know how the value is calculated. It's just taking the difference between the two bands of the Bollinger Band, and whatever you get, you divide it by the midline. The midline is just a simple moving average, and you get a percentage. What does that mean? What is a 0.28? Well, we can say that the distance between the two bands is 28% of the price or the average price of Twitter. The average price, in this case, a 20-bar moving average, is 48.78. 20, what is it? The $14 that we got as the difference between the two bands represents 28% of the value of the average. Does that make sense? So it's just a percentage of the value or the average value of the stock, which is significant because we can make comparisons to where this was historically. How does it compare to history, which is the important part, So how does it compare? Well, we look at the bandwidth here. These the dotted blue lines and red lines, those are keeping track of the highest and the lowest bandwidth values in the past. Let me see, past what? Let me double click here, go to inputs, and you can see that the length is 20. But it's not 20, it's 20 for the Bollinger Band calculation, but you can see for the bulge length and the squeeze length is using 50. These are two terms that I probably have not defined. I'm not sure if everyone here understands when we talk about the bulge length and the squeeze length. The bulge length and the squeeze length are two inputs here of this Bollinger bandwidth that refer to the two lines that you see on the plot. The blue line is the bulge. Why is it called the bulge? Because it's the highest value of the yellow line. The highest values usually represent bulges in the actual Bollinger Bands, and those bulges is when the space between the bands is higher than previous times. And of course, the other one, the squeeze length, is looking at the minimum value of that yellow line, keeps track of the minimum value, which also refers to the squeezes, or that's why it's called the squeeze length. And you have two separate inputs because you can be a little bit more biased to one side, and it gives you that flexibility. By default, they're both set to 50. In reality, when I look at these, I may want to even go further back. I'm looking at a daily chart. So 50 trading days is going to give you approximately, 2 months of trading activity. So if you really want to go back in history and measure how Twitter has moved, maybe in the past year, you may want to add more data. if we calculate that there's about 22 or 23 trading days per month, I can make a calculation and say, okay, if there's 22, let's do 22 times 12, 264. I'm gonna use an even number here. I'm gonna say 200 for the squeeze and 200 for the bulge. So what this is going to do is going to look at 200 historical days and let me know what the maximum and the minimum, what the maximum and the minimums are. Let's go ahead and take a look. I'm going to click OK. And here we are. And since I've loaded, 5 years of historical data, this may be, a way to analyze how Twitter has moved in the past 5 years. Now, every time that the yellow line touches the bottom, it's because we're entering some sort of a squeeze. So let's go ahead and do something here because, and let me look at the year 2021 and 2022. So this is 2021 and 2022. So I want to use a drawing tool here and draw a vertical. Every time that I have new lower values. I mean, I can point the touches, if that's what I want to look at, but I'm looking for a new low on that lowest value. Here we were really low for most of the year. We had some squeezes back in there. I mean, I can highlight some of the squeezes, but just keep on drawing every time that we touch the line. Like over here, we touched it. And then drawing vertical line, we have another one right here. So I want you to look at what has happened every time that there's been a squeeze. Now, if you look at the squeeze right here back in July of 2021, the squeeze kind of remained at a very low value up until, let me draw another line here, vertical line over here. So you can see how the calculation here maintained its value really close to the lowest. So if you look at that segment that I drew between the two horizontals, the two verticals, we're kind of in a sideways movement. This is really exemplifies what a squeeze is. We were coming out of a bulge. I can consider this a bulge. Then it enters some sort of consolidation between these two vertical lines, and then all of a sudden it breaks, and we can see a downtrend over here. A little bit of upward movement. We have another squeeze here. So the question is, do squeezes relate to a particular breakout? Here I can probably create another parallel. Let me do a, can I create a parallel on vertical? Maybe not. So let's go here, drawing, vertical. So something similar happened here. I had low values here on the Bollinger Bandwidth that relate to this squeeze over here. And after, the value here started picking up, notice what happens to the price activity. So I can really sit here and try to find, correlation between the squeeze and what happens to the price data. And it's very interesting the way that that a lot of times, a lot of these squeezes, precede a significant market move. Like over here, July of this year, we had a squeeze in the Bollinger Bands. We can see the bandwidth touching the bottom over here. And all of a sudden we have, an upward movement. In this particular case, we see the break on the bottom side. So after the squeeze, we get a break on the bottom side. I know that one of the ideas that we talked about is that if the break happens on the bottom side, our inclination would be to follow that same direction. But in this particular case, you can see how the price did break the bottom band, but it actually reversed. There was a pullback inside the channel, and that, represented an uptrend rather than a downtrend. So there's always a kind of a warning that some of these signals are not going to follow through the way that we expect them to. So we do have to continue our analysis and our interpretation to make sure that our signals are exactly what we want them to be, Now, let me go ahead and remove some of these lines. Let me go here to drawing, remove drawing objects, all vertical lines, remove. One of the things that I wanted to point out, and I think it's also explained inside of that PDF that I shared with you, is that the value here cannot be compared to another stock. It's like comparing apples to oranges. Right now, Twitter is showing a value of 0.28. So there's a 28%. So the distance between the bands is 28% of the midpoint. And we're in the middle of a bulge, to tell you the truth, We can see that historically, we're right here in the middle, not the maximum, not the minimum, so we're in the middle. So I wouldn't consider this the right time to trade based on the Bollinger Band idea. If we're following the Bollinger Band idea, we either are looking for a squeeze or we're looking for a breakout on the upper or the lower band, but not, what's happening right now to Twitter on a daily chart right here approaching the midline. Let's go ahead and compare this to, for example, Microsoft. Look at Microsoft. Microsoft is at a 0.11, 11%. Does that mean that Microsoft is entering a squeeze if we compare that value to the one for Twitter? Twitter was at 28%. Microsoft is at 11. Does that mean that since it's lower, that we're entering a squeeze? No. Remember, do not compare those values across different symbols because symbols have different volatility and different price movement. So an 11% for Microsoft does not mean that it's lower than the 28% of Twitter, even though the numbers are completely different, but the behavior cannot be compared that way. What this means is that the distance between the bands, it's 11% of the midpoint or the average price. That 11% has to be seen in context with historical values. What's happening historically? Take a look at what's happening here. The highest value that the percentage has been is 20% for Microsoft, which is rather, it's really consistent. 20%, it's kind of a low number compared to other symbols. I know that I'm telling you guys here not to compare, but if I go back to Twitter, you can see that Twitter reached the highest value of 0.54. So at a certain point, the bands were so far apart from each other that it was 54% of the price or the average price of Twitter. That behavior is not seen on Microsoft. Microsoft, the highest that the bands have separated is 20%. So that's where the differences are. So we cannot compare one value to the other because it's just the way that Microsoft moves is totally different than Twitter. The alert on this particular indicator is going to be when it reaches new highs or new lows. When the prices have bulged, and that's why there's also an alert on the bulge, it's really close to breaking out. So we can also establish some correlation to what happens to the price when you have these higher bulges. But the presentation really concentrates on the squeeze. And that's what I'm going to be looking at in my next example. I want to look for stocks that are close to that bottom band. The alert here, let me look at the alert for a moment. I'm going to right click on this Bollinger Bandwidth. I'm going to go here to the easy language. All right, this is the easy language for the bandwidth, and the alert it's looking at either the bulge line to be greater than the bulge line 1 bar ago, or the squeeze line to be less than the squeeze line 1 bar ago. So what it's looking for is for a change in the upper band and the lower band of the bandwidth. Let me go back here to TradeStation to explain. So what we're looking at, the upper band right here is 0.2013. So if we have a higher value than 0.2013 on the current bar, that would be a new alert. The same happens here on the bottom side. We're looking for a lower value than what it is right now. Right now is a 0.0724. That's the lowest for the squeeze. If it goes lower than 0.0724, then we get an alert. Remember that these two lines are keeping track of the highest and the lowest of the last 200 bars, which is very extreme. We can reduce that if we want, if we only want to keep track of lower days. The reason why we have 200 in there is because I started thinking about how many days do I want to track? Do I want to track the whole year? Or maybe a considerable amount, or a significant chunk of that year in order to have these prominent higher and lower levels, so that if there's a new level, it just becomes more significant because it hasn't happened in the past 200 bars. If I wanted to scan for symbols that are giving me that alert, I can use the scanner. Let me show you how to do that. Let me go here into the scanner. All right, let me go ahead and create a new scan. I'm going to click on add. Bollinger bandwidth squeeze. Bollinger bandwidth squeeze. I'm going to click next. I'm going to do it on all stocks. Next. And I'm going to do, first of all, I want to narrow it down by price. So I'm looking for a closing price that it's between 5 and 50. So I want to narrow it down to 5 and 50, 5 on one side, 50 on the other. Let me run this, see how many symbols there are. So from 12,000, we're down to 7,000. That's good. Let me customize this. Let me go to add another criteria. I'm going to go to volume, average for 10 days, greater than 1 million, run. So from the 12,000 symbols, I'm down to 734. Let me customize that. And I think that's what I'm going to be using as an universe. What I can do is I can go to indicator, and let's see. I can choose the Bollinger bandwidth. Bollinger, where is it? Bandwidth. And I can search for not that specific values here, because remember, I cannot say, well, give me the symbols that have a bandwidth lower than 10%. I mean, it could work, you can get, stocks that are squeezing, but then again, I cannot really do a comparison between symbols like we just explained. So let me do alert first and see which ones are triggering the alert. Let's go ahead and run this. All right, so this is going to run on 734 symbols. It may take a little bit longer because of the universe of symbols. This is running the easy language on 734 symbols, so it's going to take some time. But I just want to see what type of results we get. The first time it's always going to run a little bit slower because it has to download all the data and do all the calculations. But next time it should run a little bit faster. I just want to see if there's any symbols that are triggering the alert at this moment. So let me go ahead and copy this chart in the meantime. I'm going to right click, copy window, go to my scanner workspace, right click, paste window. Okay, put my chart up here, resize it. That way it has all the indicators that I'm looking for. I'm going to link the two windows together so that I can click on symbols right here from the scanner. And the ones or the symbols that the scanner is going to return should be symbols that are touching the upper band or the lower band, because that's what the alert is. If you have a new value today on the upper band or a new value today on the lower band, then give me an alert. Okay, this is almost complete. Yeah, the squeezes on Microsoft, it's just an impression here. The squeezes are not that significant. And it's just because, historically, Microsoft, it's kind of, it doesn't have these extreme movements, if I can say that. The past year, you can see that the bands don't get close to each other that much. Historically, yes, you can find some areas where there's really a significant squeeze. But in the past year, the difference between the lowest value and the highest value is just a 13%, not as drastic and as significant as other symbols. All right, so from the 734, we have 92 symbols that are triggering this alert. Let me go by volume here. So yes, NIO. Take a look at that. Okay, this is signifying a big bulge. In fact, we're entering territory of a wide Bollinger Band. We have breakouts to the bottom band. So, interesting what's happening here to this symbol, NIO. What's going to happen to the price? It's going to continue to break the bottom band. It seems to just be tanking and just touching that bottom band all the way down. But eventually, the price is going to bounce and go in the opposite direction, right? Is this the time? I don't know. Is reaching that new level of a bulge that hasn't happened in a year. What happened back in the days, right here. See what happened right here back in the days when we had a new bulge value? We have a similar behavior where the stock tanked. It was touching that red line. And when it generated a new value on the bandwidth, what happened? The price reversed. I'm not saying that this is going to happen exactly how it happened historically. Remember that we have all those disclosures that whatever we say here is just hypothetical, but it's just interesting that we can go back in history and see what happened when a new level on this bandwidth showed up, right? It's just very interesting. Let's go ahead and take a look at the next symbol, AT&T. Interestingly, is this AT&T? It is AT&T. Well, why is AT&T giving me, oh, I know what's going on here. I forgot to change the settings on my indicator on the scanner. So this is using, the default, which is looking back just 50 days. So let me go and set this to 50 days and see if it matches. There we go. So if you're only tracking 50 days of higher and lower, bulges and squeezes, then this is what it looks like. AT&T does penetrate it. Well, let me go ahead and change it back to 200, which I think you get more significant, upper and lower bands. Even 100 is good, but the more you look back, we're looking at these higher, more significant levels. So let me go ahead and change that here and try to run this one more time. I'm going to open up the Bollinger Bandwidth and change this 50 to 200 and see what type of results I get. Let's run this. Okay, so it may take a little bit longer because now instead of just loading 50 historical bars, it's loading 200. No, it's doing it very quickly. So I guess it just needs to fill in any gaps in the data that it had, but it seems to be doing it very quickly. So let's go ahead and see what happens by changing that filter. I'm sure that the list of symbols is going to be reduced significantly. We had 92, 95, I think last time. Let's see how many symbols return. Okay, so we have less. We have 16 symbols. Now let's sort by, and you can see the first symbol we looked at Yeah, that it was breaking. I mean, it was generating the alert on a 50 look back period, and it's also generating the alert on a 200 look back period. But the next one is this one based on volume, CYTO. You see that it's breaking the upper channel also. This stock is a little bit all over the place. You can see that a few days ago, it kind of traded. I mean, this whole candlestick outside of the Bollinger Bands, it's kind of interesting, right? Yesterday, it kind of traded on top of that upper band. Today, and this is a historical chart. So let's go ahead and turn this into a real-time chart. So today is inside the channel. So, but it is, bulging significantly. Let's go ahead and take a look at the next one, LFG. Wow, look at this one. Big bulges. Let's see if there's any, the thing about alerting on an indicator like this is that it's alerting on both sides. It's only alerting on both sides, meaning that you can't really tell if it's a squeeze or a bulge. Could be both. And I would have to check each one of these symbols to see if we find any that it's a squeeze. And it doesn't seem like we have a squeeze anywhere. I mean, whenever you have an up market like we have in the last few days, it's very usual to find symbols that are breaking, their bulges because price is just exploding. So that could explain why we don't have any squeezes today. But in the scanner, of course, you can use it in order to find these opportunities of squeezes and bulges that do present, it's very interesting areas of analysis. Okay. Any questions? That's the information that I had for you guys. Very interesting concept. So feel free to drill down on more details, modify the easy language, even create a strategy around this. We don't have any built-in strategies on the Bollinger Bandwidth, but it would be interesting, to design a strategy that triggers orders based on this, and then, measure the strategy performance going back in history, right? That would be something interesting to look at. Guys, thank you so much for supporting the masterclass. The radar screen has bands for sure. You mean Bollinger Bands? For sure. You can track even the Bollinger Bandwidth inside of radar screen if you want to do that. For sure. Yes, definitely. All right. Have a great afternoon. Thank you for joining me today. And I hope to see you in my next class tomorrow. Have a wonderful afternoon. Bye-bye.